So the Bank of Canada just spiked the interest rates again by another 25 points. It's now sitting at 5%. This is the highest since 2001. According to the Bank of Canada, the inflation rates are still higher than the goal of 2%. Whereas after COVID, we saw inflation rates as high as 8.13% at one point. The rate hike did have its intended effect, reducing the inflation rate to 3.4% last month. Unfortunately, that's still higher than 2%. So they raised their interest rates, and there's talks that in September they might raise it again. So if your mortgage rate is variable, well, then you're out of luck. You could see your payments increase by as much as 50 or 60% compared to your 2021 payments. This is not only affecting the homeowners but the renters as well. As the mortgage payments rise, landlords are forced to increase their rents to cover the cost. This is just a spiral of events that will eventually lead us to recession. Although I believe that we're already in recession, but the media just isn't admitting it. So with the cost of living going up, but the wage stagnating, what can you do during this tough time? Before we start, please remember to subscribe for more videos regarding financial tips and financial comedy. The first thing you should do is to cut costs. Of course, we hear that a lot, it's not rocket science. But how exactly? Obviously, doing stuff like limiting shopping works. However, other things like not eating out as much. Surprisingly, even as the cost of goods has gone up, Canadians are spending more at restaurants, increasing as much as 10% the same time at 2022. How is it that the cost has gone up but Canadians are spending more money eating out? So yeah, the first step, cut your eating out budget. If you're spending money on Starbucks and Tim Hortons every single morning, cutting that out might net you an extra 150 or 200 bucks a month. Instead, just make coffee at home for a fraction of the cost. The next step is downgrading your phone and internet plans. I know what you're thinking, hey, why downgrade phone and internet plans? They're important in our daily lives. But here's the thing, the average Canadian spends about $75 a month on a phone plan. Perhaps downgrading a phone plan for you might not affect you as much, especially for the people that's at home more often, and you really don't need a massive amount of data, since you can connect to your home Wi-Fi. I personally use public mobile and I spend less than $15 a month on public mobile, and I personally find it more than enough for my daily requirements for my phone plan. I also made a video about public mobile a couple months ago, check it out. So if you're interested in using public mobile and having a chance to save over $500 a year, use my code down below to get a one-time credit for $10 with public mobile. You can also consider lowering the internet speed at home. We humans have the tendency to pay for premium services that we technically don't always need, like a premium phone plan or the fastest internet service. By downgrading your phone and internet plans, you could cut $100 off your monthly bills. It's also a good time to look at all your subscription services to see if they're necessary. Subscriptions such as Disney Plus, Amazon Prime, or Netflix. If you didn't already spend some time studying the best credit card to fit your lifestyle, I would definitely do that. Getting the right credit card that fits your lifestyle could mean the difference between a couple $1,000s in rewards and cashback. For example, I personally own the American Express Cobalt credit card, where I take advantage of the high grocery rewards category to buy gift cards for my daily bills. Bills such as gas bills, subscription services, and Amazon shopping. If you're not pairing your credit cards with your shopping habits, now is a good time to do so. And the way you spend money might require you to own several credit cards to maximize cashback and rewards, and that's completely fine. There's also a couple of things you don't want to do during this time, like buying a car, especially when you don't have the cash for it and you need to finance it. Since cars are depreciating assets and the interest rate is so goddamn high, why would you be paying high interest rates for something that's depreciating in value? That being said, if you do have a lot of cash during this time, I would pay down as much mortgage as possible when the interest rates are this high. Most banks allow you to pay 15 to 20% of the entire mortgage per term. If you're paying as much as 7% on mortgage interest rates, it's a good time to pay down as much as possible because 7% guaranteed return on investment is not bad at all. And that's all for today. Please remember to subscribe and turn on notifications for my future videos regarding financial tips in my long form content and financial comedy in my shorts.